After reviewing the charts in this week's video, I think you'll agree the most important trends remain firmly in the bullish camp. However, we do have some cracks that are starting to surface, and we'll cover those as well. This is last week's title slide. We said the charts told us to keep an open mind about upside. After this video, the prior week, the S&P was up 15 points, Dow tacked on 170, and the NASDAQ was up 29. When the markets move as quickly as they have off of the October 9 low, we started buying with the market model on October 10th. Since the low, I believe the S&P 500 has tacked on 113 points since the intraday low on October 9th. You see a lot of personal opinions floating around on the internet, in articles, and on Twitter. In today's video, we'll try to focus on markets and how that's different from personal opinions, from the market model's perspective, what remains in the bullish camp, where are those cracks, how concerning are those cracks, and we'll look at numerous charts, markets, and ratios. We respect the fact that it's extremely frustrating, stressful, sleepless nights, the whole bit when you're on the wrong side of the market. If we want to improve, we have to understand that our job is to find charts and indicators and sources of input that help us stay aligned with the markets, rather than finding charts, indicators, or sources of input that support our current bias or how we're allocated currently. Meaning, we're all human beings. If we had missed the rally, our nature is to look for charts that tell us we were right and the market is wrong. If we want to get better, we need to focus on the important charts that help us stay aligned with the market, and our job is to read those charts and make adjustments as needed. Friday's post on short takes may be more important than this video. If you do anything this week, I would try to read the paragraphs that talk about how the price of Google stock is set in the open markets. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll revisit this table at the end of the video and tie everything together. In the meat of the video, we'll cover numerous charts listed here, and we'll talk about what's positive and where we see some cracks and how we handle that going forward. This is a weekly chart of the S&P 500 index in isolation. This is chart 1 of the CCM Big Four charts that are used in one of the submodels of the CCM market model. This chart is used in the CCM correlation model. As you might guess, that submodel has the highest correlation to the S&P 500 index. Longtime viewers know what we do with this chart. This is a weekly chart. It helps us discern between volatility to ignore that occurs within the context of a rising trend, and volatility to respect that tells us that we need to take some defensive action. A bullish look, price above blue and red, blue above red, and the slopes up. Bearish look is the mirror image, price below, blue crosses below red, that's a bearish. Moving average crossover, and my slopes are now pointing down. The probability of bad things happening increase, and the probability of good things happening increase. We always think in terms of probabilities. When we get across like this or this, we don't know how long the bearish episode will last, and that also speaks to probabilities. The current state of the chart as of the close on Friday, October 25th, unequivocally, unquestionably bullish. And this is the most important chart that we will ever look at. Why? This is price. This is the one that pays the bills. So if someone shows you a divergence or talks about a broadening top or a rising wedge or volume that they're not comfortable with. All of those things can be meaningful, but they're not meaningful until price confirms them. Price is still going up. This still looks healthy. If divergences in broadening tops and volume become a problem, which they may, they're legitimate ways to monitor markets, price will eventually fall in line and we will see visible evidence that divergences are something that we should be concerned about. The model takes this chart and numerous other charts and looks at all these indicators, and we convert that into one value or score that we can compare to historical market profiles. This chart can also speak to cracks appearing. This is TLT, long-term treasuries, relative to the S&P 500 index. TLT outperformed the S&P 500 this week in the upper right-hand corner by 0.29%. Again, not that big of a deal. There are weeks here during this downtrend where TLT outperforms. So outperformance for 1 week is not necessarily all that important. However, on the we need to keep an open mind and be careful front, you can see the ratio is trying to form some type of base here, and it too has gone sideways for some time. So that implies that we could get a breakout in this direction or a breakout in this direction. In terms of taking action, we still clearly have a downtrend on this chart. There's no bullish moving average crossover here. That's a bullish moving average crossover. Ratio went up after that. We don't have that yet, but this is something that we need to watch. If you're a stock market bear, you'd love to see this ratio clear this high here. This is chart 2 of 4 of the CCM Big Four. This chart helps us answer the question, would I rather be long or would I rather be short? Why do we look at it this way? Don't we get a very similar read that we got from looking at the previous chart of the S&P 500 in isolation? The answer is unequivocally yes. However, this gives us another perspective. All investing, and this is an important concept, involves opportunity costs. So if you read Friday's article, we talk about questions that you ask. Chris, what do you think of Coca-Cola? Well, the question that we really should ask is A, what does the market think of Coca-Cola, since the market sets asset prices? And B, what do you think about Coca-Cola relative to all my other investment alternatives, since I have limited resources in the form of capital? So here, what this does, if we get a bearish moving average crossover here, the answer to the question becomes, from a trend perspective right here, I'd rather be short. If the answer to this question is I'd rather be short, that tells us something about all the long positions that we own and the risk that we have there. If the answer to the question is I'd rather be long, that tells us something about any defensive positions that we may have had during this downturn. Obviously, the current look of this chart is bullish as well. And as you might imagine, bearish moving average crossovers in this ratio align with corrections in the S&P 500 index. Now we're looking at another weekly chart. This is chart 3 of 4 of the CCM Big Four. This one helps us answer another very logical question in terms of deploying my limited capital or resources. Would I rather be in stocks, S&P 500 $SPX, or would I rather be in bonds, AGG, is the aggregate bond fund. It's a diversified basket. Think of it somewhat as a total bond market ETF. It's very indicative of stocks versus bonds. In fact, SPY or SPX AGG has the highest correlation to the S&P 500, better than TLT or better than IEF, and hence it's weighted that way in our models. It doesn't necessarily mean that AGG is the best thing to buy when the market turns. That tends to be TLT, but this one tracks the S&P 500 more closely and more consistently, and that's the key, over a long period of time. If you have indicators or ratios in your models that have a lot of outlier events, so let's say they're helpful 60% of the time, and you can find other things that are helpful nearly 100% of the time, you want to focus on the ones that have a high correlation to the S&P 500, which you have to be able to answer the question, is this relevant? Does it matter? If you show me a divergence, can I go back in a chart and find very, very quickly several periods in history where that divergence was there and the stock market continued to go up or went up after the divergence? If you can do that, that divergence is probably not very helpful. Stocks versus bonds. If you're starting to see your chart patterns here, here's your coffee cup. And here is your handle. Here's our rim. We have a bullish breakout on the weekly chart on a closing basis now for more than 1 week. This is the early October here. We've stayed above this line here. Also want to make a point about these cup and handle formations. This acted as resistance. This acted as resistance. We all know that a high that has a resistance point in 2 places instead of 1 is more relevant than this in isolation. So this is bullish as it stands now. Price above blue, above red, and you can see the slopes of these are turning up in a bullish manner, turning up in a bullish manner, turning up in a bullish manner. It also tends to be bullish when you have your moving averages clustered together here. This is an indecisive market with price below and the moving averages kissing each other here. If we moved in this direction, it would be relevant. Here, you have your tight moving average clusters. This is a market that's unsure of itself as it rises. It becomes significant when we start to see white space appear in between the blue and the red, and guess what? Gains follow. Tight moving average cluster, indecisiveness, a little bit of white, that's a good sign. Indecisive again, then we get white again, gains follow. We get white here, losses follow. So as this chart sits now, as of the close on Friday, October 25th, it is unequivocally, unquestionably bullish. Now that may change. If it starts to morph into something like this or this, we're happy to make adjustments. This is a similar chart to the previous chart we rarely show in these videos. Would I rather be long or would I rather be short? But in this case, we're looking at the Dow Jones Industrial Average instead of the S&P 500 index. This too is a weekly chart. This is what's known as a bullish cup and handle formation. You can see here's the teacup or coffee cup, and here's your handle. If you think about it psychologically, why does this potentially have bullish implications? When this ratio moves in this direction, it's indicative of increasing economic and market fear. Here, fear comes down, makes a low. Fear comes down and makes a much higher low. So from an economic and psychological standpoint, from the millions of investors that are behind this teacup, you can think of this as a fear divergence in some way. Fear here is lower than fear here, Therefore, if you break out, you can have a bullish move in this direction. It's important to note the divergence is 100% meaningless until you get a breakout in this direction and it's confirmed. So that would be true of any divergence that anyone's showing you in a chart right now about the stock market. It may or may not be relevant. If it is relevant, so if we had divergences on breadth charts or markets that were not confirming, well, eventually, if those divergences are helpful, it will show up in the form of consolidation and or declines in ratios like this. There's no need for us to guess what will happen with this cup and handle formation. We wait for confirmation of a bullish breakout in this direction. Another good anecdotal example of things to be careful of, if memory serves me correctly, at this point here in early 2012, and this point here in Q1 of this year, we heard a lot of talk about markets that were advancing on low volume. Is that relevant? Sure, it's relevant. It's indicative of demand, and it is relevant. But it's not a reason in and of itself to abandon a bullish chart like this. So we need low volume or divergences to confirm. And why is that? Well, if I don't participate in this rally here early in 2012 because I'm concerned about volume, what happens if I'm wrong? If I'm wrong, I miss a multiple month rally. If I don't participate here because I'm concerned about a divergence on a breadth chart or a market that's not confirming something or volume that's too light for my liking, if I guess based on that and I don't wait for confirmation, then I might miss some significant upside. There's a million different ways to skin a cat. That just happens to be the way we look at divergences or low volume or anything else that's throwing up a yellow flag. If it's relevant, it has to show up here eventually. Back to the cup and handle concept. We're back to long versus short S&P 500. Here's your coffee cup, and here's your handle. This line here approximates the area of the bullish breakout. That's a successful breakout after a bullish fear divergence. This low here is higher than this low here, followed by a bullish breakout. When you're at this point here, the probability of further upside has improved. This is another chart we covered last week. Don't want to spend a lot of time on it. Just an update. We said this line may act as resistance. We also have mentioned that there's some concerns in the market this week. One of them is high beta underperformed the S&P 500 last week. All things being equal, we prefer to have high beta outperform the S&P 500. However, as you can see here, this is a trend, and by no means does SPHB have to outperform the S&P 500 every week. So we'd like to see this ratio hold above or at least near this dotted line. We'd feel better about the long-term outlook if this ratio can clearly move in this direction. This is something we'll be watching and something we can update via Twitter. This is the weekly chart of the S&P 500 we covered in last week's video. This chart is explained in detail if you view that video. 2 points here. Fractals was our example. We'll take this concept to a bigger chart. This week, it appears the blue box that we talked about last week, we've now closed above the blue box for 2 weeks. You can make an argument that this basing pattern and this basing pattern, point A here and point B here, and point C looks similar to the present day. From this point here to this point here, after the market broke out of this blue box, stocks advanced basically for 21 weeks from here to here. Point B, you break out of the top of the box here, stocks advanced for an additional 12 weeks. You break out of the top of the box here, and stocks advanced for an additional 19 weeks to this point here, telling us to keep an open mind about upside as long as we stay above the blue box. This is another chart we described in detail in last week's video. I highly recommend that you find that video and watch it if you haven't seen it, in terms of giving yourself a baseline for potential upside in these markets. Fractals tell us that the blue box in the daily chart, the concepts, should also apply to a weekly chart. We have a similar blue box here and a bullish breakout that unequivocally appears to be holding. Does the bullish breakout mean that stocks go straight up from here? Obviously, no. We've had declining weeks in here. It does tell us the odds are higher for significant upside and a bullish trend in this direction. This is chart 4 of the CCM Big Four. This is another risk on versus risk off type chart. Opportunity cost. Would I rather be in riskier and higher yielding JNK, affectionately known as junk bonds, or would I rather be in the quote-unquote safe haven TLT conservative treasury ETF? This is what risk on looks like. This is what risk off looks like. We've mentioned several times in this video that we are seeing some cracks in the present day October 25th look on these charts. In fact, you can see here, you can make an argument that we've got a bearish head and shoulders look here. Here's my left shoulder. I have a head that's higher, and I have a right shoulder here. Notice in this case, the right shoulder is higher, albeit slightly, than the left shoulder. And how do I know it's higher? This shoulder here, look how much of this line I can see. Here, it's into this line. So there's no question that the right shoulder here is higher. Also notice, if I drew a neckline here, it slopes up. It doesn't slope down. So what this is this is a legitimate head and shoulders type pattern. However, it has an underlying slightly bullish bias instead of an underlying bearish bias. This chart looks concerning. How do we know that it looks concerning? Well, we have a tie on our moving averages, and we have price below. So you can make an argument that this chart in its present form looks a little bit like this, where the stock market dropped a little bit further. You can make an argument that it looks somewhat like this period in here as well. However, notice the letter L here. The charts in this model are labeled alphabetically, and they're labeled relative to their correlation to the S&P 500, and they're labeled relative to their weight in the model. I believe L would be the 12th letter of the alphabet, somewhere in that neighborhood, which tells you on a relative basis this chart is helpful. Conceptually, it's very helpful. It makes sense that when you're confident about the economy, you'll buy riskier and higher yielding bonds because your risk of default is lower in a healthy economy. And conversely, if you're nervous about increasing default risk in a weakening economy, you'd prefer to own TLT. So from an economic standpoint, this makes perfect sense. The however that's coming is it's on the correlation front. Notice in 2013 here, we get a big head fake from this ratio. And how do we know that? Well, compare slopes here. This is the slope of the ratio. I drew it from a point to a point. The exact same period, the S&P 500 didn't fall, it went up. And after that, it went up even further. So if I take this line here and move it here, and I take this line here and move it here, it really gives us a visual on how this chart not only was not very helpful, it actually hurt us because this is a negative correlation to the S&P 500. The S&P 500 is rising while my ratio is falling. Same concept here. This line here is parallel to this line here. The length of them are roughly the same. This arrow here, same thing. This is a clone of it. Here, you can see the ratio was not very helpful at all. In fact, if we used this exclusively, we would have missed this rally in the S&P 500. See the divergences here, or the negative correlation. It's mathematically impossible to get something like this if we're tracking the S&P 500 in isolation. The S&P 500 correlates perfectly with the S&P 500, and this can never happen. The same thing is true on the long versus short chart. It's mathematically impossible to get a negative correlation event like this or a divergence like this. Long versus short mathematically has to fall when the S&P 500 is falling, and mathematically it has to rise. That right there speaks to correlations. It's impossible to get a head fake from those two charts. The further we move down the list and in the alphabet, the higher the probability of a head fake like this, and thus why as we move down the list, each chart carries a lower weight in the correlation model, which is a submodel in the CCM market model. So what does this mean? This means there are some cracks appearing and there are some concerns in the credit markets, and by no means do we want to dismiss this. However, these cracks that we've mentioned in 3 or 4 different places in today's video, one of them would be TLT beating the S&P 500 this week. Number 2 would be the S&P 500 beating high beta stocks. Number 3 would be that high beta ratio with the S&P 500 coming back down to that area, that dotted blue line that could act as resistance. This is another one. This looks a little bit shaky. However, now let's go to the summary table that looks at all of these and looks at the health and scores of these markets, and we can put this in perspective. This is the master spreadsheet for the CCM correlation model. Most of the charts, especially in the back end of the video, tie into the correlation model that we viewed in today's video. These are our charts. This is the most important, its price. This is the least important, its breadth. They're weighted accordingly. We'll go over where they stand now. But first, if you're relatively new to the fold, what the correlation model does is it looks at observable evidence. So we looked at the chart of the S&P 500 weekly. There's a binary question I can answer. Is price rising? Is the blue moving average on that chart, does it have a positive slope? Does red have a positive slope? All of these are binary yes or no questions. It's very difficult to quantify or answer a question about a divergence, a non-confirmation, or volume with a 0 or 1. There's just too much subjectivity there. The other thing the model does is it looks at hard data as well, and this is part of a hurdle model. The important thing here is these two are factual, observable things that we can compare to the past. And notice how large this spreadsheet is. If I drag this down, there's all sorts of calculations that weight these properly. And ultimately, what we do is we boil all of that down, all of the zeros and ones, and all of the hurdles that have been crossed or not crossed based upon the charts and the indicators, and we boil it down to one score between 0 and 100. Why? All of this and all of those indicators, it's overwhelming. We can deal with this. We can manage it. It's a reference point. This is a summary table that shows us the results or a snapshot of the market as of the close on October 25th, Friday. These are the charts used in the correlation model. What this tells us is the most important chart of all the questions that we're asking about price, moving averages, and indicators, including hurdles. 98% of the answers on the most important chart are coming back bullish. That's pretty important. Again, the higher you are, the higher the correlation to price, which makes sense. Price is perfectly correlated to price. Looking at the number of stocks above their 200-day moving averages, not nearly as helpful. It's helpful, but not nearly as helpful. These are not equally weighted in any way. These carry a much, much higher weight than these do. You could almost eliminate these from the model and you'd probably do just fine. What is this telling us? It's telling us that the most important charts, which are tied to price, and you'll also notice AGG relative to SPX is way above TLT. It's telling us that if we look at all of the charts, the average response is 83% bullish, 17% bearish. The median response is 93% bullish. But if I take that and I look at it for price or the most important or the most highly correlated charts, the results are much better. 96 and 97. That's a very bullish look. That's based upon observable evidence. There's no bias or opinion. The cracks are important, but they're showing up on charts that aren't as important. So if the cracks start to migrate up this table, then yes, our concerns will increase. And that absolutely, positively could happen starting Monday morning. But we have to see observable evidence to start making incremental moves to a defensive posture. We'll keep an open mind as we always do and remain highly flexible moving into next week. Also, when somebody shows you something they're concerned about and they're long, they have a lot more credibility than someone that's showing you a divergence or something they're concerned about when they've missed a 109-point rally off the S&P 500 lows on October 9th. This is Friday's post from our blog, Short Takes. It's an excellent piece relative to understanding what the Fed does, and more importantly, how asset prices are determined. I highly recommend looking at it. I think it can help all of us, myself included. All of these things are things that I've learned via the School of Hard Knocks. To find this, you can Google Short Takes Shavako, and this is the title you're looking for. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.